Hello, everyone. In this session, we're going to talk about the group account. This is one of the very important topic that will cover on this drafting and interpreting of financial statement paper. In the exam, you're expecting at least 30 marks from group accounts. Now, group accounts is the combination of the financial statement and profit and loss account. In this session, we're going to talk about the financial position. So here we're going to look at the changes and adjustment required for the group accounts in regards of the statement of financial position. That means what sort of adjustment we need to do in our balance sheet, and obviously it will be depends on different sort of requirement from the question, but the basic understanding will be same for any question anyway. So let's have a look on the chapter overview, what we have here. So let's look at our chapter overview. The first thing we can see here is says like the group accounts, the consolidated statement of financial statement. Now we try to understand in a very basic way, try to break it down in a very small portion and try to understand the meaning of each word. So the group accounts represent the group. Now, when I said the group, what does that mean? Group means it's more than one. More than one company. More than one company financial statement or more than one company accounts. And for that reason, we called it group accounts. The next word we have here, consolidated. Consolidated or consolidation means together. Together, when you prepare few company accounts, we call it consolidation. So when few company together prepare one financial statement, we called it group accounts. For example, if you have a company A and B, and these two company together prepare one financial statement, we called it group account. Now, on the financial position, we understand we have to find it out how much is the total asset and how much is the total equity and liability. The next section, we have a few things here. The first one is called parent separate financial statement. So that means even though we prepare the financial statement together, still we have to prepare the parent company financial statement separately. And obviously the reason you need to look at what is the parent financial situation and submit to HMRC. Now, when I said parent, what does that mean? Let's talk a little bit about the parent. Now, parent is the principal company, and under this principal company, there are few holding company might have. For example, let's say we have a company A, and company A is the parent company. Sometimes we call it holding company, parent company. So this is the main company, and let's say company A buy 60% of the share of company B. So that means company A have 60% right on company B, and for that reason, we will call B as a subsidiary company. Subsidiary company. So everything B have, A will have a 60% right on that, and 40% right will be belongs to B, and we called it NCI. That is non-controlling interest. So we have 60% CI, that is controlling interest. So I have a control over you for 60%, and 40% I don't have a control, and for that reason we called it NCI, non-controlling interest. Now, the next thing we have to understand how this group structure work. So to find it out, the group structure, we need to look at the subsidiary share capital. Share capital. Now, for example, if the question said the subsidiary have a total 10,000 share, or let's say 10,000 share capital, and each share is £1. So each share is £1 means the company have 10,000 share. And if the parent acquire 6,000 share out of 10,000 from subsidiary, that means the parent will hold 60% right. So sometimes the question can give you straight away by mentioning the parent have a 60% right, but it is possible the question can give you the share. To find it out, what is the group structure? So we need to divide how much share is purchased by parent and how much share total the subsidiary have. And this difference is called the group structure. Calculation will come from there. All right, so this is not very difficult thing. And the next thing, obviously a little bit different, and we have to look at some workings. So if we look at group financial statement, here is the present the result and financial position of the group as if there were a single economic entity. So you have to add the parent and subsidiary together to find it out the financial situation, show the asset and liability controlled by the parent. Share capital is that of the parent only. Parent reserve plus subsidiary post-acquisition reserve. And we have a definition of a subsidiary. What is subsidiary? Definition. A subsidiary is the entity controlled by another entity. So subsidiary is the entity is controlled by another entity. Power over the investee, exposure or right to variable return, ability to use power to affect the return. So this all give the definition of subsidiary. Now let's move on. Let's look at a little bit details. Now, if I look at here, there are a few things we need to know, and we have to be very much careful here. The first one, and the main workings we'll look at for the goodwill. This will be our workings number one. Very, very important. Goodwill represent how much I paid extra or excess of the value of net asset of subsidiary. For example, the subsidiary company, they have a net asset. The value of the net asset, for example, £100. Value of the subsidiary net asset is £100, for example. Now, I acquire or I purchase 60%. So 60%. That means it is £60. So £60 value of net asset I purchased. Now the next question is how much I paid for that, and we called it consideration. Consideration. For example, if I paid £70 to buy £60 net asset, that means £10 I'm paying extra, and this £10 is called goodwill. This is the simple calculation. There will be some more adjustment that we're going to look at later on. Now, goodwill is the reputation value of the company. For example, if you like to go buy KFC, and if you look at their net asset, for example, how much furniture they have, how much equipment they have, and after that, if you said the total value is 50,000, and I'll give you 50,000. So maybe the KFC will not be agreed, and KFC will ask you more money because of the reputation, because of the goodwill. So when we buy the subsidiary, if we pay anything more than the net asset, we called it goodwill. One more thing we have to remember, it is possible the goodwill can be impaired. It could be impaired. If there is impaired of the goodwill, we have to take away to find it out the actual value of the goodwill. Now, what is impaired or impairment? It is exactly like the depreciation, or amortization. So for any reason, if we feel the value of the goodwill we determine is now reduced, for example, maybe the reputation was very good 1 year before or last month, but for any reason, the value of the reputation or the goodwill is damaged for any reason, maybe the company suddenly doing something wrong, or for any reason, if the reputation value going down, that we will call impaired. And if there is impair of the goodwill, we have to reduce the value of the goodwill. So this is the first thing, but there will be more workings that we're going to see when we actually do the question. For the time being, if you understand that, that will be absolutely fine. The next one we'll talk about intergroup transaction. Intergroup transaction is happened when a parent sold something to subsidiary, or maybe a subsidiary sold something to parent. Now, when these two companies together, if they sell to each other, so obviously that doesn't make any sense because these two companies now become one company. And if they sell to each other, so the asset will be either to the parent or to the subsidiary. So moving the money from parent to subsidiary, it will not create any additional asset or liability because at the end, we will edit the asset for both company and the liability for both company. So of course, if I say like, okay, £100 going from parent to subsidiary, so £100 will be going down from parent bank account and subsidiary bank account will be up by 100. But if we add it together, still there will be a same result. There will be no separate effect because of this transaction. For that reason, we offset each other for this transaction. For example, if there is a trade receivables with the parent and the trade payable with the subsidiary, we do the opposite journal so that we offset each other. So for example, to eliminate trade receivables and the trade payable, we debit the trade payable and credit the trade receivables. Normally, the trade payable is a liability. Normally, it is credit. So if I make it debit, so it will be cross each other. Normally, the trade receivables is an asset. It is debit. If I make it credit, it will be cross each other. So the impact will be 0. So intergroup transaction has to be eliminated. And for that reason, you have to do the reverse entry to make it 0. The next one we have here is called NCI, non-controlling interest. We used to call it minority interest before 2014, but now we called it NCI or non-controlling interest. Here we look at the interest for subsidiary, how much interest the subsidiary have. How we calculate that? So first we need to look at the net asset at acquisition date. ACQ, acquisition date. Net asset at the date of acquisition. Acquisition date means the date the parent purchased the subsidiary. On that day, we look at how much the subsidiary asset we have. Now, for example, if the subsidiary total net asset, for example, share capital, share premium, revaluation. So adding all of this, if the asset value is, for example, £100, and if the parent owns 60%, that means the subsidiary will own 40%. So 40% is the NCI. Only one thing we have to remember, If there is a retained earnings, that means there's a profit. So we need to look at retained earnings at acquisition date and at the end of the year, we called it post-acquisition date. So you need to be careful with that. For example, when the parent buy the subsidiary, if the retained earnings was 100, and at the end of the year, if the retained earning is 200, that means during this period, together they make a profit of 100. Out of this 100, the subsidiary will have their own interest, the NCI interest. Now it depends. If the parent own 80% of the subsidiary, then 20% will be the NCI. So you need to be careful how much is the retained earnings or the profit we make during the year. The next one we have here, fair value asset. Now this one, fair value means sometimes the asset value we have in the financial statement, but the value in the market is different. For example, on the financial statement, a land value is 20,000. Maybe the land was purchased a few years back, but currently the market value is, for example, 30,000. In this case, you can make the revaluation, or you can use the fair value 30,000 rather than using 20,000. So obviously, the explanation you can see here, the subsidiary asset and the liability must be brought into consolidated financial statement at a fair value rather than book value. The reason we don't use the book value because the book value can be less, and obviously, especially for the land, if you buy land for a long time before, maybe the value of the asset is now changed. So you need to see how much is the fair value of the asset. So the fair value represent the market value or the current value of the asset. The next one is a little bit tricky. We called it inventory sold at profit. We called it PUP, P-U-P. Provision for unrealized profit. Provision for unrealized profit. So the profit that is unrealized. What does that mean, unrealized profit? So what happened if there is a sale between parent to subsidiary? Let's say parent sold 100 pound inventory to subsidiary. Now inside of the 100 pound, there is a profit, let's say 20 pound. So inside of the 100 pound, there is a profit because if you sell to someone, you make a profit. Now, if the parent sell to subsidiary and make a profit of 20 pound, and inside of the 100 pound, there is a 20 pound profit. Now, this profit has to be eliminated because you cannot keep any profit between the subsidiary and the parent. It cannot be inside of the financial statement. Any sort of intercompany transaction has to be eliminated. Now, we can have a look here. So when we have this sort of thing, the question might tell you half of the inventory still on subsidiary warehouse. That means out of 100, they sold 50 pound to the customer. If they sell it to the customer, there is no problem because money is coming from the outside of the organization. But if they cannot sell it, if something on the warehouse, for example, 50 pound goods is still on the warehouse, that means out of 100, the profit was 20. So if 50 pounds sell to the outside customer, so 50 is on the warehouse, and inside of the 50, there is a 10 pound is the profit because the total profit was 20 for 100 pound. So 50% they sell. So it's still 10 pound profit. We have another 50. And this 50 pound inventory we have on the subsidiary warehouse. So this 10 we have to eliminate. So from the inventory, we have to minus this 10. That is PUP. provision for unrealized profit. And as we know, the closing inventory always show the higher profit because closing inventory we minus from the cost of sales. For that reason, the gross profit is higher, and for that reason, the net profit will be higher. So closing inventory always increase the profit for the company. So as we show more profit here inside of the closing inventory, that means we are showing some profit on the retained earnings as well. For that reason, this £10 also will be minus from retained earnings. So provision for unrealized profit. So any profit on the inventory, we have to minus it from two places, one from the inventory and one from the retained earnings. Now, retained earnings, we have to careful one thing, from which company retained earnings? From the parent or from the subsidiary? Remember that who sold the product. If the parent is the company who sold to subsidiary, then it has to be minus from the parent. If subsidiary sold to parent, it will be minus from the subsidiary. Remember that. So if parent sold to subsidiary, then provision for unrealized profit will be minus from parent. If the subsidiary sold the inventory to parent, then the provision for unrealized profit will be minus from subsidiary retained earnings. So this is basically the basic understanding for our workings. But when we'll do the actual question, I'll discuss in more detail. Hopefully you'll be fine. Once you understand that, that question will be not very difficult, but if you don't practice well, this question could be really tricky in the exam. So my advice will be make sure the workings has to be very much careful, because if you made a mistake in one place, the another calculation will be wrong, and eventually you will be end up with wrong financial statement and your balance sheet will not be matched. So every single workings you have to be very, very careful. Let's have a look. Is there anything else we have on the chapter overview? No. So it's the introduction of the chapter. So what we discussed, if you're going to see it here. On the next section, I'll open one question. The question, we have a lot of workings. So you're going to open that question and we'll solve it together. Hopefully after that, it will be absolutely clear for your consolidation financial statement.